headline flashes across the screen. Company X beats earnings. Stock soars. Sounds great, right? But that number might be the most polished lie on Wall Street. Companies can make earnings look better than they really are. They can move numbers around, delay expenses, and make profits look bigger on paper. But there is one thing they cannot fake forever: cash. Cash tells the truth. And in the next 3 minutes, I'll show you the one page that can tell you if a company is healthy, struggling, or slowly dying behind the scenes. By the end, you'll have a simple red, yellow, and green system that helps you spot the difference in seconds. Most investors never look at this page. That's why many of them end up buying companies that look strong in the headlines but are weak underneath. The biggest mistake investors make is believing that profit on paper means money in the bank. It doesn't. A company can report record earnings while losing cash every single quarter. The news headline won't tell you that. The earnings report may not make it obvious either. So in this video, we'll follow two investors. First, there's Marcus. He sees a company beat earnings and buys the stock right away. Then there's Dana. Before she invests, she spends 3 minutes looking at one simple statement that most people ignore. One of them follows the headlines, the other follows the cash. And by the end of this video, you'll know exactly how to read that statement like Dana and avoid the mistakes Marcus keeps making. Section 1. Before we open the cash flow statement, we need to understand why so many investors get fooled by earnings. One of the biggest numbers people watch is EPS, or earnings per share. Every few months, news headlines celebrate when a company beats EPS. The stock often jumps, and many people rush to buy. But here's the problem. EPS is built using accounting rules. Those rules leave room for choices. A company can record revenue before all the cash has arrived. It can spread the cost of expensive equipment over many years, instead of counting it all today. It can also include items that change profit on paper, but never bring in real money. None of these things are always wrong. They are part of normal accounting, but they can make a business look stronger than it really is. Imagine a company reports an EPS of $2 per share. Every headline says the company beat expectations. Investors cheer, and the stock moves higher. Now look behind the headline. Customers have not paid their bills yet. Sales are growing on paper, but cash is not coming in. At the same time, the company keeps paying workers, suppliers, rent, and interest. By the end of the quarter, the business has less cash than when it started. That means the company reported strong earnings, while its bank account moved in the opposite direction. This is why smart investors never stop at EPS. Think of earnings as an opinion built from accounting rules. Think of cash as a fact. Either the money came into the business, or it didn't. Marcus sees the EPS headline and buys the stock without asking another question. Dana looks past the headline. She wants to know one thing. Did the company actually collect cash? That single question often separates companies that only look successful from companies that truly are. Section 2. Now let's look at the page that almost nobody talks about. When most people open a company's annual report, they see hundreds of pages filled with numbers, notes, and charts. It looks confusing, so they give up. Don't do that. For this video, you can ignore almost all of it. There is one page that matters more than the rest: the cash flow statement. Think of this page as a simple map. It shows where the company's cash came from and where it went. If you can read this one page, you already know more than many investors. The best part is that you only need to look at 3 boxes. The first box is operating cash flow. This tells you how much cash the company makes from its normal business. If a company sells shoes, this shows whether selling those shoes is bringing in real cash. The second box is investing cash flow. This shows money spent on things like new buildings, new equipment, or buying other businesses. It also shows money received from selling those things. The third box is financing cash flow. This tells you if the company is borrowing money, paying back debt, selling new shares, or giving cash to shareholders through dividends or stock buybacks. That's it. 3 boxes. You do not need to read every note or study every line before you can spot warning signs. Marcus sees a thick annual report and skips straight to the earnings number. Dana opens the cash flow statement first. She knows that these 3 boxes tell the real story. Over the next few minutes, we're going to use this page to run 3 simple checks. Each check gets a color. Green means healthy. Yellow means be careful. Red means stop and look closer before you invest. By the end, you'll have a simple system that helps you judge almost any company in just a few minutes. Section 3. Let's run the first check. Go to the top box on the cash flow statement. This is operating cash flow, and it answers one simple question. Is the company's main business actually bringing in cash? This is the most important check, because a business cannot survive forever on promises. It needs real money coming through the door. Now compare one number from the income statement with one number from the cash flow statement. Look at net income, then look at operating cash flow. They do not have to match exactly. Small differences are normal, but huge differences should make you stop and ask why. Imagine a company reports a profit of $100 million. That sounds great. Now look at its operating cash flow. It is only $40 million. Where did the other $60 million go? Sometimes the answer is simple. Customers have not paid their bills yet, so the money is sitting in accounts receivable instead of the bank. Other times, the company has filled its warehouses with more inventory than it can sell. Cash goes out to buy those products, but it has not come back in through sales. 1 weak quarter is not always a problem, but if this keeps happening year after year, it is a warning sign. The company may be reporting strong profits, while real cash keeps falling behind. Now let's look for the green signal. The best companies often produce operating cash flow that matches or even beats their reported profit over time. That tells you customers are paying, sales are turning into cash, and the business is standing on solid ground. Marcus sees the $100 million profit and feels excited. Dana checks one more number. She asks, did the business actually collect the cash? If the answer is yes, she gives the company a green light and moves to the next check. If the answer is no, she slows down and starts asking more questions before risking her money. Section 4. Now it's time for the second check. Stay on the cash flow statement, but move to the investing cash flow section. This is where you'll find money spent on buildings, machines, equipment, and other long-term assets. This spending is called capital expenditures, or CapEx. Think of CapEx as money the company puts back into the business. But here's the important part. Not all CapEx means the same thing. Some of it is maintenance CapEx. This is money spent just to keep the business running. Old trucks wear out, machines break, stores need repairs. Without this spending, the business cannot keep operating. Then there is growth CapEx. This is money spent to build new factories, open new stores, or expand into new markets. This kind of spending is meant to help the company earn more in the future. Both types matter. The hard part is knowing which one is driving the numbers. You may not always get a perfect answer, but you can spot a warning sign. Look at CapEx over several years. Then look at revenue over the same period. If CapEx keeps climbing every year, but revenue stays almost the same, something may be wrong. The company is spending more and more money, but it is not getting more sales in return. That is like running faster on a treadmill, but never moving forward. This is a red signal. It can mean the business must spend more each year, just to keep doing what it has always done. Now look for the green signal. A healthy company invests in its future, while revenue also grows over time. The extra spending helps create more sales, instead of simply keeping the doors open. Marcus sees a company spending billions on new equipment, and thinks bigger spending must be better. Dana asks a different question. Is this money helping the business grow, or is it only helping the business survive? That one question tells her far more than the spending number alone. Section 5. Now we come to the third and final check. This is the number Dana cares about most. It is called free cash flow, or FCF. The math is simple. Take operating cash flow and subtract capital expenditures. What is left is the cash the company can use to pay down debt, buy back shares, pay dividends, or save for future opportunities. This is money the business has after taking care of its daily work and investing in itself. But don't make one common mistake. Never judge a company by one quarter. One good quarter can happen by chance. One bad quarter can happen because of a temporary problem. The trend is what matters. Instead of looking at one number, look at the last 3 years. Now imagine 3 different charts. The first chart keeps moving higher. That means free cash flow is growing over time. The company is creating more cash even after investing in its business. That is a green signal. The second chart stays mostly flat. The company is still making cash, but it is not improving very much. That is a yellow signal. It does not mean the company is bad, but it does mean growth may be slowing. The third chart keeps moving lower. Free cash flow falls year after year. That is a red signal. The company is ending each year with less cash after paying for its business. If that trend continues, it can become harder to grow, pay investors, or handle tough times. Marcus sees one strong earnings report and buys the stock the next morning. Dana does something different. She pulls up the last 3 years of free cash flow. If the line is rising, she becomes interested. If it is flat, she becomes careful. If it is falling, she usually walks away. That is why free cash flow is not just another number. It is the number that helps Dana separate businesses that are getting stronger from those that only look good in the headlines. Section 6. Now let's put everything together. Imagine two companies. Both report earnings of $2 per share. Both beat Wall Street's expectations. Both appear in the news with almost the same headline. To Marcus, they look exactly the same. He buys shares in both companies without asking another question. Dana opens the cash flow statement. The first company starts with $50 million in free cash flow. 3 years later, that number has grown to $90 million. The business is creating more cash each year. It has more money to invest, pay down debt, reward shareholders, and handle hard times. That is a healthy trend. Now look at the second company. It also starts with $50 million in free cash flow, but over the next 3 years, that number falls to just $10 million. The company still wants to grow, so it borrows money to make up the difference. On the surface, everything still looks fine. The earnings reports are strong, the headlines stay positive, but behind the scenes, the business is becoming weaker. One company is growing with its own cash. The other is depending more and more on borrowed money. That difference may not matter this month. It may not even matter this year. But over a long holding period, small differences become big ones. As the years pass, the stronger business has a better chance to grow, invest, and create more value for its owners. The weaker business has a harder job. More debt can mean higher costs, less freedom, and fewer choices when the economy slows down. Marcus treated both companies as equals because the headlines looked the same. Dana spent 3 extra minutes reading the cash flow statement. Those 3 minutes helped her avoid the weaker company and stay invested in the stronger one. That is how better investing often works. It is not about making one brilliant decision. It is about making one better decision, again and again, until the results grow far apart over time. Section 7. Now you have everything you need. Let's put it into one simple scorecard you can use before buying any stock. If you like, take a screenshot of this part. It can save you hours of reading and help you avoid costly mistakes. Start with the green grade. Green. This is what you want to see. Operating cash flow is higher than net income. Free cash flow has been rising over the last few years. Capital spending stays under control while the business keeps growing. This tells you the company is turning profit into real cash and using that cash wisely. Now the yellow grade. Yellow grade. This means you should slow down and look closer. Operating cash flow is close to net income, but not much higher. Free cash flow has stayed mostly flat for several years. Capital spending is starting to rise, but revenue is not growing as fast. The business may still be healthy, but it deserves more questions before you invest. Finally, the red grade. Red. This is where you need to be careful. Operating cash flow is lower than net income. Free cash flow has been falling year after year. At the same time, the company keeps raising cash by borrowing more money or selling more shares. That can hide problems for a while, but it cannot fix a weak business forever. Now think back to Marcus and Dana. Marcus looked at one headline. Dana looked at 3 simple checks. That small difference changed every investment decision she made. The next time you study a company, don't start with the news. Start with the cash flow statement. Run these 3 checks, then give the company a green, yellow, or red grade. In about 3 minutes, you will know far more than someone who only read the earnings headline. And that simple habit can help you make better investment decisions for years to come. Section 8. Let's finish with 3 simple actions. First, open the annual report for one company you already own or have been thinking about buying. Don't start with the news. Don't start with the earnings headline. Go straight to the cash flow statement. Run the 3 checks we covered today. Compare operating cash flow with net income. Look at capital spending and ask if it is helping the business grow or just helping it stay alive. Then check the free cash flow trend over the last 3 years. When you're done, give the company a green, yellow, or red grade. It should only take a few minutes. Second, save the red, yellow, and green scorecard. Keep it on your phone, your computer, or wherever you research stocks. The next time you see a company report amazing earnings, pull out the scorecard before you make a decision. It can help you stay calm while everyone else is reacting to the headlines. Third, if you enjoyed this video and want to become a better investor, make sure you subscribe. Every week, We'll break down financial ideas into simple steps that anyone can understand. The goal is not to make investing look complicated. The goal is to help you make smarter decisions with more confidence. Remember what we learned today. Earnings can be shaped by accounting rules. Cash is much harder to hide. That is why smart investors always look beyond the headline. The next time you hear that a company has beaten earnings, don't rush to buy. Open the cash flow statement first. Spend 3 minutes checking the numbers that matter. Your future self will thank you for it. Headlines are written for Marcus. This channel is for Dana.